Welcome back to The Explainer. Today, we're diving straight into the deep end of M&A, specifically the math behind Purchase Price Allocations, or PPA. We're looking at exactly where high-level accounting theory collides with the gritty, practical mechanics of financial modeling.
Picture this. You've just closed a massive deal, acquired a target company, and boom, you suddenly have to account for $300 million in unrecorded intangibles. That's a staggering number, right? And in the highly regulated world of financial reporting, you can't just leave a figure like that floating in the ether.
So, how exactly do you value invisible assets? How do you take something totally abstract, like deep customer loyalty or a wildly powerful brand, and translate that into a hard, audit-proof dollar figure on a balance sheet? Here is our roadmap for this explainer. First, the Intangible Valuation Challenge. Then, we'll spend a lot of time on our main focus today, generating results with MPEM. After that, we'll hit the relief from royalty method, the cost approach, and finally, complexities and audit hurdles.
Starting off with Section 1, the Intangible Valuation Challenge, moving from accounting definitions to valuation mechanics.
When senior valuation managers tackle this, they generally look at three primary frameworks: the income approach, the market approach, and the cost approach. But here's the thing. The income approach is by far the most common for unique intangibles. Finding public comparable data for the market approach is incredibly rare. I mean, you can't exactly just look up the market price for someone else's proprietary customer relationships, right?
That brings us to Section 2, Generating Results with MPEM, the engine of intangible valuation. This is really the core of what we want to focus on today.
NPEM, the multi-period excess earnings method, is the absolute gold standard when you're dealing with primary income-generating assets. We're talking about your customer contracts, your long-term relationships. Think of MPEM as a high-powered extraction tool. It's a mechanical filter that strips away all the background noise to isolate the exact cash flows generated specifically by your existing customers.
So how does MPEM actually generate these results? Well, it breaks down into 6 sequential steps that take raw gross revenue and filter it down to a polished net present value. You forecast revenues, apply the customer churn rate, deduct operating expenses, deduct CAC, discount the cash flows, and finally do a tax shield add back. Let's dig into how these mechanics actually drive the final valuation.
Right off the bat, steps 1 and 2 are all about isolation and decay. We absolutely have to separate revenue coming from existing clients from any future yet-to-be-acquired clients. We only want to value the relationships we just bought. Applying that customer churn rate is totally critical to seeing how those specific relationships will naturally decay over time, which we model out mechanically using historical attrition analysis.
Jumping to step 4, we introduce the Contributory Asset Charge, or CAC. Look, you can't generate customer revenue in a vacuum. The CAC is essentially the economic rent paid to other assets, like working capital, fixed assets, or tech, that physically help generate those revenues. We literally deduct this rent that we owe to other supporting assets just to keep our isolated customer revenue perfectly pure.
And for step 6, we have the tax amortization benefit, the TAB. This step is brilliant. We add back the TAB because the very act of amortizing this newly valued asset over its useful life provides a massive tax shield for the business. That shield has real, calculated cash value, so it gets added directly back to our net present value to generate the ultimate final result.
Moving on to Section 3, the Relief from Royalty Method, valuing brands and technology.
Now we're panning across to distinct assets like trademarks and core patents. The logic here is basically a giant thought experiment. What would it cost if you had to rent this brand name from a perfect stranger? The Relief from Royalty Method flips your perspective entirely. It asks, how much cash are you saving simply by owning the asset outright instead of paying someone else to license it?
To actually execute this, valuation experts hunt down comparable third-party licensing agreements using benchmark databases, places like RoyaltyStat or KT Mine, to find a realistic royalty rate. Once we have that rate, we project the revenue base tied to the trademark, calculate the hypothetical savings, apply tax effects to get the net cash savings, and then discount that to NPV. Oh, and just like with MPEM, we add back that tax amortization benefit.
Next up, Section 4, the Cost Approach, valuing software and workforce.
So, what happens when an asset, like internal use software or an assembled workforce, doesn't actually generate isolated cash flows or licensing savings? That's where the cost approach steps in.
We essentially list the precise inputs needed for duplication. We're calculating exactly what it would cost to build the asset from scratch today. We look at developer or engineer hours to rebuild, apply fully burdened labor rates with all the overhead and benefits, and then make adjustments for developer productivity, technological obsolescence, and testing costs.
But hey, there is a major accounting catch you need to know. An assembled workforce is actually not recognized as a standalone intangible asset under rules like IFRS 3 or ASC 05. Keep in mind, while we absolutely use this cost method to calculate the workforce's CAC rent that we deducted earlier in the MPM process, the value of the workforce itself, that just gets completely absorbed into goodwill on the final balance sheet.
Finally, Section 5, Complexities and Audit Hurdles, the final reconciliation.
Let's zoom back out. To survive a rigorous final audit, everything has to balance mathematically. You've got the WACC, which is the buyer's baseline cost, and the IRR, the transaction's implied return. But the real true test here is the WARA, the weighted average return on assets. The auditor is going to rigorously check that the WARA, which is the blended weighted return of all your individual asset valuations, including cash, intangibles, and goodwill, perfectly reconciles with the overall transaction IRR and WACC. And you can't forget about deferred tax liabilities, or DTL. Stepping up the value of these acquired intangible assets creates tricky book tax timing differences. Because of these timing differences, your final goodwill number is correspondingly pushed even higher. It's a cascading effect.
And this matters immensely for the future of the business. How you allocate value between short-lived intangibles and goodwill directly dictates the stability of the company's future P&L. If you allocate heavily to short-lived intangibles, you get higher annual amortization, which continually drags down net income. On the flip side, allocating to goodwill avoids that amortization hit entirely, but then you're stuck with risky annual impairment testing. It is a massive strategic balancing act.
So we've explored the tools, the rules, and the mechanics. We've completely built the MPEM engine. But how do all these theoretical models actually translate into a real-world, multi-billion-dollar press release? Are you ready to see this math in action? Join us in Part 3, where we'll open up a live financial model and execute these exact steps line by line.